Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have John Proctor, the CEO, and Aaron Crow, the CFO of Martello Technologies Group. Martello trades on the TSX Venture under the symbol MTLO and in the US under DRKOF. The company is trading at 18 cents with roughly 303 million shares outstanding, or about a $54 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trevor. Great to have Martello Technologies here, a company that I know a number of our subscribers have actually told us we should interview, so we're happy to get the opportunity to do that today. CEO John Proctor, Aaron Crow, CFO. Happy to have you guys here, and I'm just going to turn it over to you and let you start your presentation.
Hi, Paul. Thanks for having us, and Trevor for introducing us. I'll kick this off, and we'll go through this little presentation, and then we'll pause and open up for questions and some back and forward discussion. If we just drop to the next slide, please. There we go. So usual comment, but the first thing I'll do is talk about what digital experience monitoring is. So what does Martello do? And really, it's kind of the old premise. Unless you're solving a business problem, you have nothing to sell, right? Nobody's going to pay for something that doesn't actually solve a problem. And if you look at sort of what we do, and the left-hand edge is the technical piece. So we provide synthetic transaction monitoring in a couple of areas. One is for Office 365. That's a recent acquisition. And we've been doing it for years for Martello. And the real user monitoring, the endpoint device level performance. And we pull that together with another tool we acquired called IQ into this overall digital experience monitoring. And that's important because, again, it gives these business outcomes. If you're a business, and particularly in this hybrid work environment where people are working from home, you really want to know, how productive is my team? And, are they productive with the stuff I have bought? And the other part of this is your modern CIO compared to your 15-year-ago CIO doesn't own anything. And that's a bit of a gross oversimplification, but we talk about software as a service, and nobody talks about software service as a culture shift for a CIO. If you go back 15 years ago, the CIO had a data center, he had servers in his own data center, and he had applications running in his own environment. Now he has none of that because he's running software as a service. In other words, he's gone out to Salesforce, he's gone out to SAP, he's gone out to Microsoft to say, I want to buy your product to give me an outcome. I don't want to own it, I don't want to update it, I don't want to run it. Just deliver me, the ability to word process, run spreadsheets, and communicate on Teams. Got it, done. Well, then how do you measure if it's successful? And that's one of the things they're now looking at, saying, well, and it's now got worse because of Office 365. I don't even own the network. So when you have all of that, and your IT team is also working disparate, how do you ensure productivity? And how do you ensure the cloud stuff you're paying for is delivering the return on investment you expect, connected to productivity? But also, one of the things we also find is when you've now got to troubleshoot. So let's say, Paul, I'm going to pick on you because you're on the screen sitting above me. Let's say you had a problem with your home machine. It was Office 365. And you call up the help desk, in whatever company you work for, and said, hey, my Office 365 sucks. I can't speak to people on Teams. SharePoint takes too long. Can you help me? And they go, we've got no connection between you sitting at home and Microsoft. So how about you turn your machine on and off first? And you go, well, then and it's because they have no visibility. We provide that visibility. We provide that IT guy the ability to say, I can see exactly what's going on. It's not Microsoft's fault. It's actually not the internet service provider, Bell, TELUS, Rogers. It's none of those guys. It's actually your home network, because Paul, somewhere in your house, there's 2 people on Netflix. There's another person who's playing Call of Duty, and somebody else is using another voice video conferencing tool. So your home network isn't able to provide it. So it's actually a you problem, not an us problem. And you do that very quickly, and that solves the problem. So in a very simplified piece, what I've explained here is saying we provide all this analytics into an IT team to be able to deliver those business outcomes on the right. Next slide, please. And what we see is this is where this growth is going. And I'm pulling Gartner. At the moment, digital experience monitoring is still a fairly new area. It was only, that term digital experience monitoring was only coined by Gartner last year. And what we see is it's around 15% of companies have got it now. By 2023, so just in a couple of years, that'll be 60%. That's a fairly explosive growth that we are tapped into, we are well positioned for, and expect to go. And again, we see this acceleration by COVID. It was always going to happen. This is nothing new, this maturity from service level agreement to experience level agreement. Service level agreements tell you that something's on. Experience level agreements tell you how well it's working. Well, that's up the value chain. That's a more mature approach. And we've obviously also hitched our wagon to Microsoft. And I'm very, very comfortable with hitching my wagon to Microsoft's growth, particularly in Office 365, when they've already got 1 million users in 365, and that's growing. And we also seen their teams increase given COVID as well. Next slide, please. So we've got our organic growth strategy, and then M&A are inorganic. So if I look at our organic growth strategy, we've still got Mitel as a basis underneath. We're still growing Mitel, single figures growth, but it's extremely valuable revenue. It's extremely important to us. It pays a lot of the bills, and we've been there for years. We are the only unique analytics tool that Mitel has. That is their DEM solution. But then I also look at what we've acquired with this organic Microsoft user capability. We've already come out publicly saying we expect that we'll be at 3.2 million users by the end of Q4 FY22. That's an awful lot of data. We've already got, as I said, shows on the style, we've already got over 2 million Office 365 users. We're seeing a 60% growth. We expect a 60% growth in that. But then we want to layer on top of that is M&A. We're either looking to add a depth in Microsoft or breadth, more real-time SaaS tools. Think SAP, think Salesforce, think other tools that enterprises are dependent on, and they don't just care, they care as not just that it's on, they care how well it's performing. And again, this is where we'd fit. And again, other target requirements in there. So we're really trying to pull that together, organic and inorganic growth to keep driving Martello forward. Next slide, please. So what can people expect in FY22? So really, we've scaled now into FY22. We've got capacity. We've got this fabulous growth engine. And like any sales and marketing team, you've had to pivot, right? A lot of us small tech companies relied upon the Microsoft events, the Microsoft Ignite, and other physical events where you could send a sales team down, they could introduce Martello, they could say, here, this is who we are, this is what we do. Well, none of us can do that. There are no physical conferences. There are no high-tech conferences. It's not happening. So we've pivoted into a very much a digital campaign, and I'm very pleased with how strongly we've done that. And I've seen other tech companies have really struggled to do that, whereas we've maintained. And I'm very pleased, given the economic uncertainty around COVID, how well we've pivoted onto a digital-only channel and maintained our clients and continued to grow. We will see much harder into channel sales development. When we acquired GSX, and that was still under a year. We haven't had a year with them yet. They were very focused on direct sales, which is the one-to-one model, which is great. I want to do one-to-many because that's the growth path. So we're going to really push in FY22 into channels, channel sales, managed service providers, cloud service providers, because we really can't get into the small, medium enterprise. We just can't scale down to do one-to-one there, nor do I want to pay the massive overhead of having a sales force that will do that. I want to do one-to-many, one sales guy running a channel partner that can attack many targets. We're doing more work on integration, work from anywhere solutions. We will see cross-sell and drive. I've got a strong sales pipeline. We're seeing the upsell and cross-sell in bookings, and our revenue quality is high. We've got 96% recurring revenue, 93% gross margins. Any tech company our size on the TSX-V would be delighted with that. So I'm very pleased that we're already seeing 96% recurring revenues. So again, I think there's good pieces there. So I'm just going to hand over. We'll do a couple of pieces now on sort of the financial highlights, and I'll hand over to Erin, who's our CFO, to take on the financial highlights for everyone.
Sure, thanks, John. So I'll just touch briefly on the next couple of slides on some of the key metrics coming out of Q3, which ended in December, and just our year-to-date numbers and some of our other key financial pieces. So if we look back historically at the performance of Martello, back in fiscal 17, we were purely a Mitel shop. So 100% of our revenue was from Mitel, and that would apply for both fiscal 17 and 18. We've done, as John mentioned, a couple of acquisitions since then, so in fiscal 19 and again in fiscal 21. And so we can see the growth, both organic and inorganic, through fiscal 19 to fiscal 21, coming from both the existing business and then these acquisitions that we've completed. So our CAGR over the period has been above 50%. As John mentioned, throughout this whole period of time, and no change expected in the future, we've had well over 90% of our revenue recurring. It's all subscription-based. The Mitel revenue is monthly royalty fees. So very strong, solid revenue base from that perspective. And gross margins have tracked historically above 90%, and we expect them to continue in that range going forward as well. I'll just make a note that the fiscal 21 revenue that you're seeing there is based on our Q3 revenue as a run rate for fiscal 21, just because we acquired GSX, or the Microsoft product, partway through the fiscal year. So in Q3, some nice metrics coming out of the quarter. Our MRR is just under 1.5 million. Our total revenue about 4.6 million for Q3, and so that's the number that we based that run rate revenue on for the fiscal year. As we've talked about already, strong recurring revenue base of 96%. And we've broken our revenue down into a couple of different buckets. So we've got the Mitel revenue, which represents about 43% of our revenue in Q3. We've got the fast-growing Microsoft DEM space, which was about 40% of our revenue in Q3, and actually grew 17% from Q2 to Q3. And then through our acquisitions, we have a couple of pieces of legacy business that are really driven by, they're monitoring some legacy infrastructure. And so that represented about 17% of our revenue in Q3 FY21. And we'll see that declining over the next couple of quarters. And we expect that to be fully out of our revenue stream sort of through fiscal 24, I would say.
Thanks, Erin. Yeah, I'll take on. So just to sort of, give people an oversight of who's who in the zoo, I'll go with the management team. And you just heard from Erin. And I know this is a fairly hefty Canadian-focused grouping. I tease Erin quite a lot. Erin was the CFO of the Canadian Senators, so she's used to dealing with a really challenging environment. And then the rest of the crew also has Doug from Newbridge, Rob and Olivier, both came by acquisition, both former CTOs, and Mike and Tracy rounding out the crew. So a very strong leadership team for execution. And we've got a very engaged board, and some of the board members folks will recognize. Sateri, who's fully engaged. I certainly chat with him at least once a week. Bruce, most of you know him from his Canopy Growth time. What a lot of people don't realize is he was the CEO of Martello before me. Canopy got really busy, and that's why he transitioned out and I came in. And then the rest of the crew, Mike, McCullish and Jennifer, both from QNX. Jennifer is now the CFO of the Canadian Mint. Don Smith, former CEO of Mitel, and the rest of the crew is very strong. And they're a very engaged board, very strong. So I'm very conscious that I think we've got a very strong both management team and board that will both deliver on execution and make sure we are executing successfully. So I'll just one more slide and we'll just summarize and then open up for a question. So, again, I think one of the big things people ask is why Martello? Why should I, look at Martello and say I'm going to potentially put some money into this company? As Aaron mentioned, high quality SaaS revenue, 96% revenues recurring, just under 1.5 MRR base, and very strong gross margin, which again, numbers I'm very, very proud of. We've truly, and I showed both the team capacity to execute. One good example there was we'd found GSX before COVID. We'd had the initial discussions before COVID, and then COVID came, and suddenly we'd only met the leadership, and we still had to try and execute on M&A, and we did it. We executed as a very small, tech company, executed a acquisition and an integration, on a Swiss headquartered company, and I still haven't met some of the key players within in person. I've met them in 2 dimensions, but I haven't met them in person, and we still managed to integrate, and we still managed to grow sales. So again, I'm pleased with the leadership team and the global team in having achieved that. I've talked a bit about Microsoft 365. Yes, we've got Mitel, as our foundational element. Mitel revenues is a key foundational element. Key foundational element for us, and then Microsoft 365, right? Hitching our wagon to that is not a bad place, pulling us through with their own growth. And what I will see shortly in the next few months is us becoming a Microsoft managed partner. We've talked about this before, and those of you know how difficult that is to, 1, get there, and 2, be asked to do it by Microsoft is key, because it means Microsoft starts selling you themselves. When you transition from sort of the co-sell program into the managed program, it means no longer you trying to sell with Microsoft alongside, Microsoft are trying to sell you as well. So that'll be a big shift for us in the next couple of months. And then tech comparables, and we have coverage by a number of tech analysts. And this is one thing they keep harping on about, saying, look at Martello's comparable to the other tech companies of our size or slightly bigger, and we're clearly undervalued. And every analyst we've had, every coverage we have states that quite clearly. So I'll pause there and open it up. I think Paul will pause there and let you ask questions of Aaron and I.
Fantastic. Thank you, John. Why don't we start? I didn't see a slide there that gives us a good understanding of what your total addressable market is. Maybe give us a sense of, call it the low-hanging fruit, where you guys really dominate, and then the bigger picture of what you could be. Yeah, and it's one of those things with digital experience monitoring being a relatively new term. There are variances on what that TAM is. I mean, Gartner will tell you it's an $800 million market. A few other people will say it's a over $1 billion market. So it is growing. And if I look at sort of, we're just in the Office 365 space at the moment, I'm talking purely about DM and Office 365 at the moment. That's an 800 million by itself. So that's that piece. Whereas if I look at sort of, if we decide to acquire into digital experience monitoring bigger, then yes, you're now talking into a multi-billion-dollar space, because we're pulling digital experience monitoring in for other applications that have their own addressable market. So purely that Office 365 digital experience monitoring is around an 800 million plus market space that I think we can take, as I said, growing from 15% to 60%. And I think we can take a significant proportion of that as that grows. Mm-hmm. And give us a sense of what your competition looks like. Great question, and I'm going to break it down a little bit. So if I look at the first thing, which is our capabilities into Mitel, there is no competition, and that sounds arrogant, but it's because we're the only tool that Mitel white label. So if you've bought a Mitel phone system, the only tool you can have for analytics is Martello. And it's kind of simple. It's a bit of a closed, it's a bit like, a closed forum for that. And actually it's very risk management, because it would be really expensive for Mitel to
find somebody else to replace us, because we've been there for 9 years. We're fully integrated into their marketing, their business processes, their product lines. And when you white label somebody, you've got to be much more integrated than just a value-added resale. Flip that across to Microsoft, and of course there is competition, right? It's such a big environment. Gartner came out last year and said there are four companies that do digital experience monitoring for Office 365, and we were one of those four. Well, actually, GSX was before we acquired them. Cisco acquired another one. Cisco acquired a company called Thousand Eyes. They're a huge player in that space. We've got more depth. Cisco, Thousand Eyes were much more sort of network focused, much more broader across the spectrum of digital experience monitoring. We're very dedicated in that digital experience monitoring space. And then there's a couple of other small players in this space. But one thing those guys, none of the other three do, is synthetic transaction monitoring. That's one of our differentiators for us. So again, a little bit of competition in there. And I think it'll get busier. So this is part of our reason we need to have velocity is, we won't be the only people in space. Those won't be the only four companies, but we've got ahead and we've got this toehold and we're pushing much faster than I think anybody else is at the moment.
Why don't we dive a little bit into your sales strategy, your sales model, and sort of who your ideal customers are?
Yeah. So I guess two questions there, which is sales strategy and clients. At the moment, our clients tend to be big enterprise and or government, mainly because if you look at sort of early adopters of technology, it will be big enterprise. They've got the capacity to understand. So whether it's, large, billion-dollar Canadian insurance firm who just renewed with us. In fact, that was this morning. They renewed their licenses with us this morning, to a global bank out of Hong Kong. Those are our targets and clients at the moment, fairly sticky. If you look at the Mitel side, you've got everything from United Nations to Major League Baseball to Premier League soccer in the UK. So again, big household organizations. When you see, I don't know if any baseball fans, on the call, but when you see them pick out the phone in the dugout, that's actually a Mitel phone, and it's our analytics running in the background to make sure it works. So I'm comfortable with that being fairly sticky. So those are sort of where our clients tend to be, is on that scale. What we want to do, though, as a sales strategy is get into more partnerships. So speaking to the big, systems integrators, some of the big managed service providers, and become a value add into their environment, which means, creating a whole partner program. And that's rolling out this quarter. We're rolling out this big partner program this quarter. A lot of work going into that, because that'll be the one-to-many. Because, much as there's lots of large, big enterprise, there's an awful lot more small enterprise. And I just cannot scale to go and take those guys. And it's not cost effective for me to do so. It's cost effective for partners who already have relationships, who have already given them an Office 365 offering, and us to just layer on top of that. So that's our one-to-many sales approach in that respect.
And maybe walk me through what it takes to get a lead, to get sort of through the sales process, and then ultimately, what are you guys looking for? You're looking for a long-term commitment. How long does that usually last?
Yeah, I mean, the last question is the easy one, is 2 to 3. We generally look at 2 to 3 years. The Mitel one, we've got clients who've been with us 9 years. So, again, you got everything in between. But we generally, most of our contracts are minimum of 1 year, if not 3 years. And we had one client mid of Q4, bought 3 years in advance, right? Just paid 3 years in advance up front to go. And as you can expect, government clients, end of year money, let's pay 3 years in advance and I don't lose my budget approach. For the other part, really, I think we'll see more aspects of bringing it, I guess, trying to think how we do that, trying to explain that. Bringing it forward in terms of, sorry, I keep seeing pop-ups. I get distracted. I do apologize. On share consolidation, I should stop focusing on this. Sorry, Paul. Just reinforce me on the first part of the question again, because I focus on the second part.
I'm trying to walk through the sales process. How long is the sales process, and how do you generate leads? I'm trying to think of these enterprises. Yeah. They tend to be pretty fickle to allow somebody in and just start playing around with their enterprise. Is this a 1 month sales cycle? Is it 2 years? Do you have to go from?
It's not, yeah, it's not 2 years. So the first thing is, how do we generate leads? At the moment, it's all digital, right? So we're doing a lot of ebooks, we're doing a lot of videos, a lot of webcasts. We're trying to do as much as we can to generate those leads. So, marketing enabled leads, product enabled leads, and then top of cross sell. So that's really the focus at the moment, because not one client is saying, please come visit me. It's just not happening. Please get on a plane and come see me is not a conversation anybody's having. So we're just really dependent on those digital leads. I urge everybody, go on our YouTube channel, go and look at our ebooks, right? Where there's another one coming out shortly about experience level agreements versus service level agreements. So we're really publishing as much as we can in that space. Then in terms of closure, on the Mitel side, it can be ridiculously quick. We learned from Mitel that they've sold a phone system, and then a week later they've upsell the analytics as well, and we've got a deal done. So that one can be really quick. You're right about the enterprise time, though. We are seeing normally around 3 months to 6 months as a sales cycle. It's somewhere in there. As you said, they want to be somewhat cautious. Generally, they want to see a proof. We call it a proof of value. It's not a concept. We know what the concept is. We're not giving you a proof of concept. We're proving the value inside environments. So generally, a lot of people these days want to see proof of value. We've got a lot of those going on at the moment. I'm really pleased with how many proof of values we've got running into FY22. And generally, we've got a fairly solid conversion rate on those, over 60% conversion rate. If we get into proof of value, we can show. The other thing that's nice is we're agentless. So this is also part of key. And what that means is, if your IT team, Paul, had suddenly decided we're going to buy this, and now we're going to keep an eye on Paul and tell him what he's doing, we don't have to put an agent on your laptop. And that's really important, because that slows down your machine. It takes up bandwidth by itself. And it means the poor IT agents have to go around and make sure everybody's got something installed. We don't do that, right? We just need those credentials to be able to set this up. And then it can monitor you without having to go down to run an agent on your machine. And that really helps an IT team. So that stops some of the complications around that. And I think that becomes really, really important, is making yourselves user-friendly to IT guys. And like you said, shorten that sales cycle. But we're seeing the proof of values as becoming a key step as a guide to closure.
Mm-hmm. How many? Give me a sense of how many customers you have, and any customer concentration, or even what's the typical size of a contract?
Yeah, and I'll probably let Aaron take that last part as well. But yeah, I mean, there is no particular concentration. We're truly global. Like I said, we've got banks in Hong Kong, we've got clients in Australia, we've got clients in South America. We actually, the irony is we have the United Nations as a client, right? You don't get much more global than that. I've got the government of Birmingham in the UK, and then and all points in between. So it is a huge mixed bag in that respect. And Aaron, do you want to talk about deal size and the and length?
Sure. Yeah, so deal size, it actually varies depending on the nature of the product right now, because we haven't launched this integrated product yet. But the Mitel business is a per month royalty. It's like somewhere between 11 and 20 cents, depending on the product. So that's a very different pricing model than anything else. And then for the Microsoft contracts, the average deal size could be anywhere from, let's say, $50,000 to a couple $100,000. And for our monitoring or for our analytics product, the deal sizes are anywhere from, let's say, $10,000 to $100,000. So, and it's based on number of integrations. So the pricing models are different depending on the product at this point, and we are looking at shifting to a consistent pricing model for both the analytics and the monitoring, the Microsoft products.
Fantastic. You mentioned sort of new products. That's a question we always ask, is just generally new products or new initiatives. What new stuff are you working on, or new geographies or anything? I just throw the word new in there somewhere. What do you got?
Yeah, so new is good, and one thing we're focused on is really this work from anywhere problem, and this we call it, the real user monitoring piece. So advanced network path monitoring, so I can see all the way from my house to the Office 365 server and all points in between. And how do I help that? And then the same with call quality on Teams, et cetera. So there's a whole bunch of new features we're pulling into this, and then really also the integration, and that becomes key. Why that is so important is Microsoft's really good at crushing the opposition. And I bring that out because if I don't think anybody on this call is using WordPerfect anymore. They crushed, Word crushed WordPerfect. They did it. And now they've got Teams. And if you talk to the Microsoft folks, one of the key things that Microsoft sales guys are doing is push Teams, push Teams, push Teams. Features are coming out. And you can probably work exactly who they're going after because we're using their tool right now. And no, CEO is going to say, you know what, it's okay, get rid of Microsoft completely. We're going to keep Zoom.
Right.
It's not going to happen, right? Because every finance team wants a spreadsheet. Every slide, sales guy wants PowerPoint. So who's going to win this battle? I know where my money's going to be on. So just putting that right out there. But what you've got is the telco guys like Mitel going, how do we work together? Right, because I've got these hard handsets, I've got phone sets that people still want. Yes, we were all on soft clients, we're all doing soft phones, but a lot of businesses still need telephones, right? Hard clients. So Mitel has already come out and said we will integrate with Microsoft. Right, so you can already pick up your Mitel phone for a Teams call. And you can make a Teams call across a Mitel phone. So this is where well, fun enough, we already straddle that. So what you'll see from us is being able to bring this. If you're a Mitel partner and you sell Mitel phones as a service, a lot of them also sell Office 365 as a service. So what we're going to do is be able to pull that together to, one, make their systems more efficient by able to say, there's the Mitel system, there's the Microsoft system, and we'll pull them into one picture. So when the client calls and says, I can't talk to people, you know exactly why. That makes your life easier. It makes your life more efficient. It also is a value add that you can bring, particularly as we go into the next step. And I mentioned the data, which is we've already hired a couple of data scientists. So we're already starting to look and saying, what we can see inside this in data that we hold? And I'm not going to call it, artificial intelligence. I think that's a grossly overused term. The best we're at machine learning levels. So we're wrapping machine learning around this to say, what can we see from the Office 365 data we have already? And can we connect the dots? Are there certain, for instance, internet service providers, because the way they're configured, give you a better Office 365 experience? Right, and all points in between. So that's where we'll probably go with that. So you'll see a data play coming from us. You'll see more work on machine learning as we add this sort of data environment, and then bringing that value back in. And the aim overall is to become proactive. So if you can imagine, and again, Paul, I'm sorry, I keep using you as my IT troubled guinea pig.
I create a lot of IT trouble. So
yeah, is the way our system works. We do synthetic transactions. We don't actually need you to be in Office 365 to measure your experience. Right, so you could actually open up your system in the morning and there's an email from your IT guys saying, hey, before you start work, we can already see you're going to have a problem. We'd like you to do the following things that will solve your Office 365 problems before they start. Cool. Well, one, you like it because it's made your day more efficient. Two, the IT guys like it because you don't call them in the first place. And three, you just save the company an awful lot of money on both sides. So again, this is where we see ourselves going in new.
That's great. Let's switch gears a little bit. Obviously, last year, dealing with COVID, two questions. One is, how did your operations change due to COVID? And what are the opportunities or pitfalls that have been created because of COVID?
Great question. So we were fairly easy to adapt, right? We're an IT shop. It was kind of, relatively easy to say, everybody grab your monitor, grab your chair from the office, go home. And that was kind of where we all sort of started, and then we settled in. So one of the key things is, how do you operate a company where you don't see each other, you don't get to talk to each other? Well, we've done a lot of work on sort of social fabric, everything from, Friday get-togethers, you name it. How we operate as a company has been recognizing that you're still reliant on sort of the small talk. you're still reliant on having a relationship with your coworkers. How do we keep those? How do we create those, environments? And what sort of social events can you do while we're all socially distanced? So that's kind of where we, as a company, changed. And then the other big thing, as I said, is we shifted this digital sales model right down a digital channel. And I think, again, come back to the point of saying, and we've done this while we've integrated another company, while we've added, millions more revenue, while we've added, tens of more people to the company. We've done this all from effectively from lockdown. The other thing is recognizing different parts of the company at different stages, right? We've got folks in Nice, people in Paris, folks in Amsterdam, folks in Geneva. We don't necessarily have a bricks and mortar office in all those places, but people live there. And then the team in Canada and sales guys in the US, got a sales guy in Singapore, and a customer support guy in India. They're all going through COVID differently. Right? They're all in different stages, and recognizing that you've actually got to accept that and understand how they're all dealing with it. And then the other point is recognizing that, some people have school-age children, and they're struggling with homeschooling and do other things. And for some of our, R&D guys, and I've made this comment before, this was the best thing ever. Right? They can get up in the morning and climb into their gaming chair, and the first thing in the morning, they write code all day. Then they get out of their gaming chair, have dinner, and then get back in their gaming chair to play games with their friends online, some of which they work with. And for some of them, they're like, I think this is perfect. I didn't like being in an office anyway. So you got to recognize you have all points of extreme of people who can't wait to be back in office, and people who say, nope, don't want to be there. And I think that's how we've adapted as a company.
Mm-hmm. Great answer. And then in general, like you touched on it a little bit, but the opportunities that have presented themselves from COVID, are you seeing an increase in demand? Are you seeing new opportunities they can jump on?
Yeah, it's both a blessing and a curse, I think, in many ways. The blessing aspect is, you're absolutely right, with it's exacerbated the system. I think DM was always coming, it's accelerated it, and it's made the need to understand the ability to access and help people, even though they're remote, they're not in the office. How do we help them? It's made that more visible as something that's going to need to be done. And also for CEOs who are now, recognizing, well, hold on, there's a degree of economic uncertainty. What am I spending my money on? It's more important to justify the spend. So if you can't show the productivity level, how do you justify the spend? So we see those conversations becoming more and more. The curse is, for a lot of people, it's taking more time, right? Because nobody's in an office. So when we say we want to do a proof of concept, everything takes a little bit longer. Every conversation takes a little bit longer. And at the same time, even our internal conversations take a little bit longer. When a client has a problem, you can't just walk to the R&D guy next door and say, so what do you know about X, right? And you can talk it out over 15 minutes over a coffee. Now it's hey, do you have time to talk? Yes. Okay, I'll look on your calendar and find a free spot. And everything just takes that little bit longer. So that's the kind of the curse on this side.
Yeah, no, fair enough. I agree. I noticed you just recently raised just over $5 million. I think $5.75 million, if I'm not mistaken. What are your use of proceeds? What are you going to spend that money on?
Just because I've got a cough, I'm going to hand over to Erin for a second.
Sure.
Yeah, so I think, really I'd say two key areas of focus on the use of proceeds, right? It's really around R&D. A lot of attention this year on product features, functionality enhancements, really driving some of these integrations that we've talked about. And then the second piece would be the sales and marketing aspects, right? So we're really focused on the channel strategy. We've got to build up our channel team and our, all of the support functions that go around that, and then continuing to expand our sales team to drive additional revenue, right? So as this, we know the demand is out there, and we've got to really make sure we've got the horsepower behind us to meet that demand.
Mm-hmm. You mentioned you guys have done some M&A in the past. Are you looking for more M&A? And if so, is it a function of wanting new technologies or new add-on services, or is it relationships you're looking for? Yeah,
Take that,
Aaron
John?
or John.
Yeah.
Yeah, I don't mind. Either of us. Aaron, why don't you answer, because it'll be the same as mine.
Yeah, so I would say our focus is primarily on the first part of what you talked about, right? The technology, the breadth in the DEM space, or the depth within the Microsoft space, or the monitoring, the analytics of Microsoft. However, I think the relationships and customer side of it is something that we look at absolutely when we're talking about the different targets and assessing them, because it's really important that we don't find a great technology, but that's selling to a completely different market, right, than we're selling to, or has a different profile from a revenue perspective, right? It's not recurring, or it's, really small deals as opposed to these larger enterprise customers that we would typically be dealing with. So I would say focus on technology, but certainly looking at that relationship, customer relationship side of things as well, just to make sure there's a fit there from a strategic point of view.
Okay, gotcha. Before we jump to some listener questions, just a little bit on the stock. I understand you've got some coverage. I believe there's three analysts covering you, if that's not, is that correct?
Yes.
Okay, so okay, great. For a relatively small company, you guys have some good solid coverage. How much the makeup of the stock right now? What percentage is owned by insiders, and maybe talk to any significant shareholders?
Yeah, so insider ownership right now is about 18%. The majority of that is Wesley Clover, or Terry Matthews Holding Company. And he recently put $1 million in through the bought deal that we just did. So.
And any sense of what kind of institutional ownership you have right now?
Yeah, we don't have an exact percentage right now. I would say if we look back, sort of when we first went public, it was historically retail, with the last two deals that we've done. So last May and this recent deal that we did in March, primarily institutional. So we've had some nice interest from the institutional side over this last year with some, and I think we've had some of them reinvest as we've gone forward. So I think good signs there on the institutional side from a growing that institutional interest and investment.
Okay, perfect. Why don't we jump to some listener questions? It's always a treat to see what kind of questions we can get. If you guys are ready, I'll jump right in here. We'll start here. Okay, here we go. What percentage of TAM does Martello have? Do you see yourselves gaining TAM market share quicker than peers in the future, and how will you outperform? How do you answer that?
Sure. And hi, Sean. Always nice to get questions from you, and I like when you attend our other calls as well. So Sean knows us. Yeah. So we think, and again, we're going by Gartner numbers, Sean. So it's kind of difficult for us to quantify, but we think we're around sort of 15 to 20% of the TAM at the moment is where we're at. And yeah, we absolutely tracking that market share quicker. I want us to go faster. I want us to get up. If we're at 15, I want us to take 20%. 20% or 60% is a good chunk for me, right? I think that's a good take for me. And I'm really going sort of, Gartner still hasn't fully quantified this. So I'm kind of going by their metrics. So I think we're around sort of, I'm going to say more around, I think we're at 10 to 15%, but I want to get to 20%. And I think that's going to be the key metric for me, is saying, as you say, as the market grows, are we are we growing our percentage of the market? I think one of the key metrics there is going to be seats. And I'll use that as a key sort of indicator for everybody on the call. When we close a deal, we announce we have this many Microsoft seats. It doesn't mean we've got the revenue yet. There's a lag between getting these Microsoft seats and getting the revenue, because we have to onboard. And we've mentioned before, we've got one partner who's got 800,000 users we're moving on board. Well, we're onboarding around 40,000 a month. And that's still a lot of people. That's still 40,000 people are onboarding a month, and that's their speed. We're limited by the partner's speed. But that's 40,000 a month to get to 800,000. And they still want to grow the 800,000. So as I go towards 800,000, they're moving the yardstick to 900,000 because they want to create more people in their premium version. So that will be a leading indicator for you, for everybody, for any shareholder, any potential investor, is Office 365 seats, and we're going to keep reporting that, as we go forward. And we said we expect 60% growth in this financial year on Office 365 seats, which will be a leading indicator of what revenue will be as well, because again, it should tell you that some of that revenue won't be in when we announce the seats.
What kind of churn do you have with your customers?
It's interesting. I'll take that one on initially, and then let Aaron have a go as well. If you look at the Mitel, it's really low. It's ridiculously low churn, just because you bought a Mitel system, and as Aaron said, it's 11 cents, for a analytics. So people sort of, it's almost insignificant for the overall cost of a phone system. So those guys don't churn too much. With a couple of the other products, we've got 2 legacy products. We haven't mentioned those 2. We've got a couple of legacy products which give us high churn, and they came with the acquisition. One is to do with Domino, and those of you old enough recognize Domino is connected to Lotus Notes. Again, I don't think many people have that. People still renew that. Like, don't get me wrong, we are still renewing that, but that still means we have a decrease, right? Because people are not renewing that hit, and it gives us probably a higher churn than we would like overall. Because we have these legacy products. Another one is for SCOM. We acquired that with Civision. SCOM is a legacy on-prem Microsoft product that nobody does anymore. People still renew it, but again, it's churn, so we're losing people. So once those legacy products have churned out, you will see, effectively a better, higher retention rate, because we'll have got rid of those products. Aaron, do you want to add on to that at all?
Yeah, I think the only thing I would add there is that the legacy pieces of the business have been reducing, right, year over year. So right now they're about 17% of our overall business. So as those churn out, the impact of that churn will be felt less and less, obviously, on the overall revenue as a whole. So.
Okay, fair enough. Perfect. Okay, let's get back to some of these questions here. Okay, so 300 million shares outstanding. We've got a question asking any plans to consolidate your shares?
Yes, as soon as we possibly can. I mean, I shouldn't laugh, but we get that question quite frequently, right? It is a lot of shares outstanding. It impacts our share price, so it's an important consideration for us, and it's something that we do want to get done within, I would say, the next 12 months. It's just finding the right opportunity to do it when there's a transaction, or needs shareholder approval. So there's just some processes we need to go through, but it's absolutely on our radar and something that we want to get done. So.
Okay, great, good to know. Okay, next question from Sean again. So obviously somebody who knows your business quite well. It's going to be an intelligent question, I'm sure. Martello recently announced a reseller contract to convert incumbent monitoring services for 800,000 users to Gizmo. How's the transition going, and what does the revenue split look like for that? Who wants to take it? John?
Yeah, I'll start it off, and then I'll again hand over to Aaron. So yeah, we're pleased, Sean, with the the partner program, this reseller contract. We are onboarding them. We speak to them. What is really nice is they're being very open on what else could we do for them. And it's always nice when you have a partner saying, yeah, and if you could do this, this, and this, it'd be even more value. So we're having a lot of conversations there, and I like that relationship. I mean, still, we're still under a year with them. I mean, they're still onboarding their clients with us, and they're already sort of settling in. And the key there is, it costs them to have a new product line, right? If you're a MSP, putting a new product into their environment costs them. So they've got to have a certain confidence that you know what you're doing and you're going to be around for a while. So that is going well, and I like that. Aaron, do you want to take on the revenue split aspect?
Yeah, it's actually quite straightforward. I mean, we simply receive a per user fee from the partner, which is obviously, they're actually burying the cost of the GSX or Microsoft product within their overall price to the customer, and then they pay us a per user fee for the actual product. So pretty straightforward.
Gotcha. Okay, perfect. Okay, next question from Sean again. Question related to investor presentation, or the recent investor presentation. Is the 2024 user projection of plus or minus 24 million realistically attainable?
I think I have to ask a question about that one. Where did that come from?
Sean's going to have to answer that.
Is that, Sean, just maybe you can type, is that from the presentation we just gave? Because I think, I will say the piece in there where we talked about the user projections, we've been talking about going from 2 million in October of 2020, growing that by 60% through Q4 of fiscal 22, which is March of fiscal 22. So, from going from 2 million to 3.2 million over that sort of 18-month period. So that's the user count projection that we've been talking about with the market. We are tracking certainly well on to those numbers. We're confident that we're going to get there.
Gotcha. I mean, I've heard the sort of 60% number a few times. So obviously, you know, we view that as hyper growth. So you guys believe that you can grow at that kind of rate for at least the next few years? Yeah,
I mean, I think you know, we have to remember that's on the Microsoft segment of the business, right? So it's not on 100% of our business, but and it's as John mentioned earlier, it is a leading indicator. So sometimes we get ourselves in trouble and we say, okay, our user count has grown by, let's say 15, 20, 30%. The revenue follows it, right? It lags it. So people are expecting that hyper 60% revenue growth, but it's actually, we have to bear in mind that it will lag behind the user counts. But we absolutely think it's attainable. If you think about the 800,000 users that we're onboarding through this reseller agreement, I mean, that in itself constitutes a good chunk of that user growth. So yeah, so we see, and we've seen the progress even just since October.
Fantastic. As investors, what do you think are the metrics that we should really be watching to see whether it's lagging or leading indicators, but what kind of metrics should be watching to really understand that you guys are executing on your business plan?
Yeah, so I think the two key pieces that people should be looking at are the user counts, because I think, as we said, it's a really key leading indicator for us of the growth on the Microsoft DEM business. We get challenged sometimes because of this decline of the legacy business. It mutes some of the growth that's happening underneath it. So that leading indicator is important. And I think as well, you know, we've started talking and you know, in our Q3 results, we disclosed some of the information around the actual DEM, Microsoft DEM revenue growth. So we split our products out a little bit differently. So really looking at that high growth area specifically as we move forward, and the growth in that area is a really good indicator as well, a good metric to be considering. Yeah.
Okay, perfect. I got a question here that says, any plans to uplist to the TSX or NASDAQ? You guys are obviously growing and you've got a solid base of business. I'd expect at least the TSX, but any grander plans?
It's something we've talked about. It's not something I think that's in the, you know, imminent future, but certainly something we continue to keep our eye on and think about. But we've got a lot of activity going on right now to try and, you know, spend a lot of time and effort getting this foundation in place. And right now we're really focused on driving that revenue growth. And then I think we'll start talking a little more deeply about that. I would say John can jump in, but
yeah, I think at the moment, if I said to the finance team, I want to list on the NASDAQ, I'd have a bunch of finance people trying to beat me stupid with a stick, given the tax implications and the overhead cost. And I think, you know, shareholders are looking for us to run fairly lean and mean at this stage and perform. So the cost of the overhead cost of going to the NASDAQ is, you know, would be prohibitive at the moment. And when we're ready, yeah, I think that's the other thing is I would see uplifting to the TSX as a next step when we're ready, and then NASDAQ when we're big enough to be able to absorb the cost of that.
Yeah, no, I agree. I've got very close sort of information in terms of what the costs are to NASDAQ, and it's a lot more than I thought. So
yes,
I really suggest you take your time. Yeah. Okay, another question. What does the product roadmap look like beyond adding real user monitoring and network performance monitoring?
So there's a number of pieces where we want to integrate. So the more we can pull the pieces together, the better. And then the other thing is cloud-based multi-tenancy. One of the key aspects here is when we acquired GSX, the Gizmo product that delivers Office 365 isn't multi-tenant. And what that means is it's not really scalable down to small enterprise, because otherwise you have to create a new instance for every new client, which sucks. So cloud-based multi-tenancy is a key aspect of this. The plus side is what we do for Mitel is fully cloud-based multi-tenancy. So we have expertise already in how to do this, and we've got the team that created Gizmo. So we're putting those guys together to create a cloud-based multi-tenancy of Gizmo or IQ. The other thing that's the guys are focused on at the moment is it's actually quite complex to become a Microsoft managed partner. There's a number of things in here in terms of Azure consumption. How are you what do you have in Azure? So for instance, we have capabilities like our IQ product. We need to make sure that's in Azure, and then as we sell the Gizmo, we're increasing Azure conversation. That's what excites Microsoft. So there is quite a lot of work on that side as well, which isn't actually necessarily pure product. It's how we run the product and how that makes Microsoft happy in the way we run our product. And I think, any of you have anybody know anybody who works for Microsoft, just ask them how important it is or how significant it is to become a Microsoft managed partner. It's huge significant. It isn't easy. The fact Microsoft have invited us is significant all by itself, and we will step through that to get this done. So again, really pleased we've been invited, but there's a lot of work. So it isn't as simple as saying, yeah, we're doing all these cool, updates, and I make jokes about it. It's just typing, guys. How hard can it be? You're just typing. It's writing code. This is actually more complex because it's all around the utilization of the products in specific cloud environments that make Microsoft happy.
Mm-hmm. Mm-hmm. Gotcha. Okay, we're going to take one last question from the listeners, and we'll start to wrap up here. Embedded in the 3.2 million users forecasted for fiscal 2022, does this assume any incremental indirect channel partner signings, or is this assuming pure organic direct to enterprise wins?
Thanks, Gianluca. Nice to have you on the call. Yeah, I think, Gianluca. You kind of know I'm fairly, I prefer understated. I'm confident on that one. So yes, this is pretty much our own organic direct enterprise wins at the moment. We're modeling our own successes. Signing a couple of indirect channel partners will significantly up this. So I'm being conservative. I'm okay with being conservative. I'm risk adverse at the moment, given coded economic uncertainty. So I'd rather understate and overperform. So yes, this is pretty much what we've got with our own sales team, our own plans at the moment. Signing up a couple of large indirect channel partners will push that number up.
Perfect. Okay, we've come to the part where we like to give you guys a chance to just sort of leave a parting message or a key takeaway for all our listeners. Anything maybe we missed, or anything investors should really look forward to in the next little while. What's that key takeaway you want everybody to walk away with?
Well, I guess first challenge is we're in a bit of a quiet period. We will make some noise, as much as we can in the near future in terms of some sort of partnership pieces. Nothing obviously material, but certainly because we're in the quiet period. But certainly we'll trickle some news out that's appropriate given the time period, and then financial results coming out at the end of June. And really, as I said, is please watch the Office 365 numbers. I think they'll make a difference, and at the same time, watch the team execute. I think that's kind of key, is saying we've got all the moving pieces. And I used on a recent call, I use a steam engine analogy. The pressure is absolutely building. The company really feels that we're putting everything together. We're getting recognition from our validation from our proofs of values, right? That we're doing the right thing. We've got validation from Microsoft that we're doing the right thing. So I feel that absolute pressure building, and it's like any steam engine. Once the pressure builds, there's nothing you can do. The train's going to go, and that's exactly how we feel at the moment in the company. Fantastic.
This has been great. I've learned a lot. Certainly, I've got a much better understanding of what you guys are all about. If others want more information, what's your website address where they can go to?
It's www.martello-tech.com. quite a few resources on there, and then it's again, I think it was on the end of the show, so I'm just making sure I've got it right because I can't remember if it's investor. Yeah, it's investor@martellotech.com is the email address, and Tracy gets those, so we'll deal with those. Always happy to hear from people, but please go on the website. We have a YouTube channel. People can go there and see videos on what digital experience monitoring is and what it means. And if there's any questions, please reach out to us. So that's investor@martellotech.com.
Fantastic. John Proctor, CEO of Martello Technologies, Aaron Crow, CFO. I want to thank you guys. It's been a great learning experience for me, and hopefully same for all our listeners. And we look forward to catching up with you guys, hopefully for a future update, if that's okay.
Yeah, look forward to that, and thanks everybody for their time today, and for you, Paul, having us on. Appreciate you taking the time, and Trevor setting it all up.
Fantastic. Thank you both so much.